Many of you have probably seen this image, which President Trump posted. He posted, essentially saying that he's going to introduce a 50-year mortgage and solve the housing crisis. I've got a lot of thoughts on this. Let's dive into it. So I want to start with the framing. The framing of this is the affordability crisis. And if you're paying attention here, you'll notice one thing. They didn't say the housing price crisis or the livability crisis. It's the affordability crisis. It's not that the prices are too high, it's that you can't afford them. From that lens, the solution is really easy. Make it easier to afford things, and then you've solved the affordability crisis. Well, there's a couple ways to go about making things more affordable. You could try and bring the prices down. Deflation. Deflation has a problem, and that is that deflation brings deflating wages or stagnant wages, as well as deflating prices. And nobody wants to be paid less or never get a raise. So some level of inflation is considered healthy. But the way that our economy inflates varies over time. Check out this chart, which is the difference between housing prices and wages from 1985 and 2025. You can see that the inflation we had varied a lot. And because it's very difficult to bring wages up across the board, since they're dictated by private corporations and individuals who do or don't ask for a raise at work, or do or don't get one, it's negotiated by unions and collective bargaining agreements and MOUs and all these things. It's very complicated, but housing prices are even more complicated because housing prices are based on the sales of other homes. They're based on comps. And what that means is that as they begin to rack up and rack up and rack up, they get into a spiral that is harder to tackle than wages. How we dealt with this in the 1930s, just like President Trump posted, FDR introduced the 30-year mortgage. We went from 10 to 30 years. Instead of having to pay off your house in a shorter amount of time, which meant larger and larger payments, you got to pay it off in a much longer amount of time, which meant smaller payments. A smaller payment every month would allow individuals to afford a home more. But you didn't change wages or prices. Remember, those things are very hard to affect, especially with policy that can get passed in the United States. We don't have a lever that just controls wages or home prices. It's a very complex system. But we do have a lever that controls the leverage that individuals are allowed to have when purchasing a home. So we introduced the 30-year mortgage with the goal of making it easier to buy a home. Lower monthly payments, a longer overall time frame. You end up paying way more, so the banks were happy because they make a lot more over the lifetime of the loan. Now we're in 2025, where home prices have far exceeded incomes. What do you do about that? Well, give more leverage. Instead of 30 years, we go to 50 years. And that allows you to have smaller monthly payments and a longer runway to pay them. There's a problem with this. And the problem is that the 50-year mortgage just doesn't make sense mathematically the same way that the 30-year mortgage did. Let me explain. Take a look at this chart. This is the comparison between a 15, 30, and 50-year loan on a $300,000 house. As you ratchet up the term length, you end up paying more and more interest. It should be obvious to anyone paying attention, but look at the sheer difference in the total interest paid against the difference in the monthly payment. Instead of saving $700 a month going from 15 to 30 years, you're saving $240 a month going from 30 to 50 years. And the problem is, instead of adding $140,000 to the loan, you're now adding $220,000 to the loan. $220,000 over an extra 20 years. And what do you get out of it? $230 a month? That doesn't seem right. Over the course of the loan, you'll have saved $55,000, but you'll have paid an extra $215,000. It doesn't make a lot of sense. If you're missing $240 a month to get a housing payment, probably aren't well capitalized enough to own a home. Owning a home takes a big reserve of money because things could just break in your home and you need to fix them. If you've got a leaky roof, you need to fix the roof. And that could cost a lot of money. If you're in the middle of winter and your water heater goes out, you want hot water, so you have to get it fixed. If you're renting somewhere, that's the landlord's problem. owning a home is a good thing, don't get me wrong. You build equity in it, and that equity is usually, as we've seen in the difference between income to housing prices, better for you than working harder at your job. It would be better to own houses than work. That's why we have a class of professional landlords. You may have been served one of their ads before this video. I didn't make any money on that. I'm too small. So if you can't make the payments, an extra $240 a month on a $300,000 home, you're probably not well capitalized enough to get that home. But that may be different if the difference is $700 a month. Keep in mind that when I'm talking about the 30 versus 50-year mortgage here, it's not as comparable from the 15 to 30. The movement from 15 to 30 was a big deal and saves a lot of money over the course of the loan. It's still not as efficient, and it's definitely, if you can make the payments on the 15-year, better for you, especially at today's interest rates. Keep in mind that interest rates today are much higher than those of a couple years ago. If the interest rate on your mortgage is 3% or below, you're currently below inflation. That's free money, and you don't need to change anything. But if your mortgage is, say, above 5%, then it could make a lot of sense to try and pay some of it off early or to refinance into a shorter term length. There's an elephant in the room that we need to address, and that is amortization. Mortgages come with a very specific structure, and that is that you pay the interest up front. So the loan works like this. The first payments are basically only interest. Then you get a set of payments that are a blend of interest and principal. And then you get payments that are just principal. Banks structure mortgages like this so that they make most of their profit up front. And we'll talk about why a little bit later in the video. Because the payments are amortized, it means that in a 50-year mortgage, you pay so much interest for so long, here's a good chart showing the timelines, that it takes you from a $400,000 loan, it takes you 31 years to get the principal value of the loan down by a fourth. Now, the other 3/4 of that get paid off in the last 19 years of the loan. But for the first 31 years, over half the loan's lifespan, you haven't meaningfully earned any equity. And we can look at the 30-year mortgage where you hit that in year 14. Before you get to halfway, or just about halfway, you hit your first quarter, and the payments accelerate even faster than that. So this chart shows us just how much home you own over the course. And keep in mind that the simulated interest rates here, 6.25 on the 30-year and 6.5 on the 50-year, are speculation. The last chart had a higher 50-year mortgage rate, but most of the spreads are the same. We can see that by year 8 and a half, the 30-year mortgage has earned 10% of the house. By year 16, it's earned 25%. By year 25, it's earned 50%. So this means that the 30-year mortgage owner, who in this instance is saving, $240 a month on a $300,000 home, they've earned half of their home at the same point where the 50-year mortgage owner has, 15% of their home? 14%? That's not great. That's really bad. And I can already hear the counterpoints. Oh, but Jack, no one actually owns these mortgages all the way to the end, right? Most mortgages turn over in 7 to 10 years. And that's true. Don't get me wrong. But we can look at that and see how it goes. In this chart, blue is the 50-year mortgage and green is the 30-year mortgage. We can see that green gets a higher down payment improvement. So if you saved up the equity that you earned in the home over those 10 years, you end up ahead, quite a bit ahead, almost twice as ahead, even though they have a lower monthly payment, but they make less equity. In fact, over that 10 years, they've made almost no equity at all. And when they sell their home, they're just paying off their mortgage. They don't really have a good down payment saved up. Looking at housing, one of the beauties of getting a mortgage is the leverage you're able to have. This is why we're just adding years to the mortgage term, because that increases the amount of leverage you can get. But leverage isn't good if the leverage is amortized. So instead of really creating a better rate of return because of a steeper amount of leverage, you have a much worse rate of return. The 50-year mortgage earns a 200% rate of return on their down payment over that time. But the 30-year mortgage is at a 467% rate of return. Here's why the 50-year mortgage really matters, because no one's going to force you to get one. You've seen the math, you know it doesn't look good. Okay, cool. Well, just don't get one. But there's going to be a lot of people who need a 50-year mortgage in order to afford a home. These are these people who are not well capitalized enough to be a homeowner. That, by the way, is the problem that we need to fix, not affordability per se, but the purchasing power of the individual. That's for another video. So we're going to enable a whole group of people who basically can't afford a 30-year mortgage to still be able to buy a home. They're going to get a 50-year mortgage. And this will bring up home prices. Why? Supply and demand. Very, very simple. If you create artificially, through the use of 50-year mortgages, you create more demand, but you don't create more supply, and we're not revving up the amount of housing that we're building at the same time as we are introducing this 50-year mortgage, and you create this excess demand without supply, then prices will go up. That's just economics. So if you own a home currently, the introduction of the 50-year mortgage is, in a roundabout way, kind of good for you because it's going to raise your home value. You're going to have more people to be able to sell your home to, and that excess competition is going to raise the price of your home. And it's going to be at the detriment of anybody who actually gets a 50-year mortgage. So I've been kind of a doomer about mortgages, but here's my solution. Current homeowners don't need any help, and we can see that in this chart. This is mortgage debt service payments as a percent of disposable personal income. So how much of your income that doesn't go to keeping you alive, how much of that goes to mortgage debt? And we can see that today we're at a level higher than 1985, but not as high as that first chart may have indicated, despite the fact that people are making a lot less than homes are priced. The average homeowner isn't paying that much more for their mortgage than they used to. In fact, the level today is below where it was in 1990, and certainly below where it was in the housing bubble. This, by the way, is the chart to watch so that when you know we're actually in a housing bubble. Jump in 2005 is what led Michael Burry to The Big Short. We have to increase supply at the same time, and not the kind of supply that we're currently working on. Right now, when we're working on housing, a lot of what we're working on is rentable housing. It's housing units that are designed to be owned by a corporate landlord and rented out to individuals, so luxury apartments. And otherwise, we're building single-family home tracts that are priced so high to begin with that new homeowners can't get them. The median age for a first-time homebuyer right now is 40. So we know young people can't afford homes. They're stuck in that very first chart of not making enough to current home prices, and they can never get onto the low percent of disposable income because current rates are too high and current prices are too high. It would cost them 15% of their disposable income, and they just can't afford that. It's a complex problem because the economy is a giant system, and it's not solvable by any one policy. This policy, the 50-year mortgage, is not it either. Just expanding access to leverage and expanding access to cheap debt through interest rates are not going to be enough because they're just going to raise prices even more and cause us later on to need longer and longer mortgages. Look at Switzerland, where they already have a 100-year mortgage, and they're passed down to children and grandchildren who live in a house that is just forever owned by a bank. It's kind of like renting, but the landlord doesn't fix your roof or your water heater. I don't get it. And I hope we never get that far. In fact, I was surprised that how much pushback the 50-year mortgage actually got, even from President Trump's supporters. So we need to build condos instead of apartments, things you can own, but small units that appeal to younger people who can afford small units. We need more multifamily housing tracts where we're building duplexes and quadplexes instead of single families. Yeah, that leads to more investor interest instead of individual interest, but it increases housing supply in a very dynamic way. And it's density that doesn't destroy the character of single-family neighborhoods that luxury apartments kind of do. If you've lived in one of these luxury apartments, like I have, you understand what I mean. All 3,000 of us are crammed into a little building, and yet everyone's a stranger all the time, and everyone seems to like it that way. My crazy idea that we as a society have not explored is the opposite of retirement communities. I think it'd be very interesting if we built some communities that were locked to under 40s as opposed to over 55s. What if we had some young people housing tracks? What would that do to supply and demand? I think it would bring prices down, and that's something we actually want. If you've made it this far in the video, by the way, thank you so much. You're one of 30% who get all the way to the end, but you would absolutely benefit and enjoy from reading my newsletter every week. I send it out for free on Sundays. Once a week, you get one email from me. It's a roundup of the most interesting charts and ideas that I found that week. I cover business, technology, markets, economics. It's called the Macro Obsession. You can find it linked down in the description. And I'll see you next week.